Good morning, ladies and gentlemen. It's my privilege to welcome you to the Czech National Bank's quarterly meeting with analysts, whose purpose is to present yesterday's decision of the Czech National Bank Board and also a new macroeconomic forecast. Giving us the benefit of their insights today are Czech National Bank Governor Jiří Rusnok and Executive Director of the Monetary Department, Petr Král. The first item on our agenda, as is usual, is the new macroeconomic forecast, which will be presented by Petr Král. Petr, you have the floor.
Thank you for the floor. Thank you. Good morning also from my side. Ladies and gentlemen, it is my great pleasure to be here again after some time giving the presentation of the Czech National Bank's new quarterly macroeconomic forecast. My presentation will have the following structure. First, I will introduce the assumptions based on which the new macroeconomic forecast has been formulated. After that, I will show the story of the new forecast. After that, I will provide you with a brief comparison of the new forecast with the previous one. And final part of my presentation will be dedicated to an updated disorderly Brexit scenario, which we prepared during the latest macroeconomic quarterly projection exercise. As for the external assumptions, you well know that the euro area, which is our major trading partner, has been going through some deceleration of economic growth, which is very closely related to the decline in volumes in global trade and also related to trade disputes among US and its major trading partners in the world. We can expect that GDP growth in the euro area is about to bottoming out from the current very low levels, and the forecast assumes that the growth will accelerate slowly in next two years. The PPI growth in the euro area, the growth of producer prices, is also quite subdued, following the economic deceleration of economic growth and reflecting also the previous decline in crude oil prices. So both the core item and the energy item within this, or component within this foreign PPI growth has been declining over time, and we can expect only gradual recovery of PPI growth in coming quarters. The ECB, facing all new information, has further relaxed its monetary policy by cutting the depo rate by 1/10 of a percentage point to minus 0.5%, and it resumed its QE program, asset purchasing program, in a 20 billion euros per month volume. This decision of the ECB to resume this APP program has been reflected in our forecast by reintroducing the shadow nominal interest rates for the euro area, which embodies the effects of the APP program. The deviation or the difference between the headline 3-month Euribor and this shadow rate is approximately 0.3 percentage points on the whole forecast horizon. The October consensus forecast, which we take into account when formulating these external assumptions, expects that euro will be only gradually strengthening against the US dollar from the current weakened levels. Here you can see the decomposition of foreign PPI growth into both core component and energy component. And as I was describing before, the PPI growth has been decelerating in recent quarters, and it has almost stopped now. The prices stopped from growing, and the major contribution to that was the declining contributions of the core component within this index, and the energy component has also contributed significantly, switching from positive to negative territory. This energy component is on the forecast on the current conditions and on the forecast strictly connected with the expected gradual decline in crude oil prices. As for the domestic assumptions on fiscal policy, we identify quite significant positive fiscal impulse for this year, being approximately plus 0.5 percentage points, stemming from the government fiscal discretionary measures taken effective for this year. This fiscal stimulation of the economy, of the domestic demand, has been going especially through the private consumption, and also government investment activity has been promoted by the fact that Czech authorities try to do their best to spend as much money as possible from the EU funds as we are approaching the mature stage of the current programming period. This year's positive fiscal contribution will disappear over the next couple of years due to the fact that in 2020 there are some new fiscal discretionary measures to take effect, but their effect will mutually compensate. That's why the overall impulse is zero, and for 2021 there are no more fiscal discretionary measures to come into effect based on the latest available information. The government budgets will stay in surplus, but the surplus in proportion to GDP will gradually decline over the forecast horizon. The government consumption, which is benefiting from high pace of public sector pay and other current non-investment revenues of the government, including outlays in healthcare and including benefits in kind. So the government consumption is growing quite significantly, and we can expect that this growth will continue, but it will be a bit slower compared to this year. Let me now turn your attention to the basic plot of the new macroeconomic forecast. Inflation will stay in the upper part of the tolerance band around our 2% inflation target in the coming quarters, and will return gradually to inflation target at the beginning of 2021. The decrease of inflation towards the target, so the convergence from above to the target during the next year, will be slowed by the impacts of indirect tax changes, which are part of the forecast. Consumer price growth has been quite vivid in recent quarters and months, and the latest available figure is 2.9 to 2.8 for Q3 this year. The overall price development has been driven by the major contribution of core inflation, and especially non-tradable sector, which is services basically, within this core inflation segment, has been contributing quite significantly to the core inflation developments. But the headline inflation was also promoted by quite significant positive contributions of accelerated growth of regulated prices and also of food prices. On the other hand, the contribution of fuel prices has been still quite negligible. According to our forecast, as I mentioned, headline inflation will stay in the upper part of the tolerance band and will get gradually to the vicinity of the target on the monetary policy horizon, which is the end of 2020 and beginning of 2021. Monetary policy relevant inflation, which is the headline inflation excluding primary effects of indirect tax changes, will be below headline inflation in 2020 and very close to it as from the beginning of 2021. The deviation or difference between headline inflation and monetary policy relevant inflation is, as I mentioned, the effects of primary effects of indirect tax changes. Here in this graph you can see the profile of both primary and secondary effects of indirect tax changes we introduced into this forecast. So as from the beginning of next year, we can expect quite significant increase in excise duties on tobacco products, cigarettes, and on alcohol, making a contribution to the overall CPI of approximately 0.6 percentage points. The introduction of the third and fourth, let's say, wave of electronic sales registration has been postponed to May 2020, and in close connection with this electronic sales registration is the reclassification of certain items within the consumer basket from the basic VAT rate to the second reduced VAT rate, which is, as I mentioned, will take effect as from 1st of May 2020. We expect that this reclassification, this reduction of VAT rates on such items like, for example, hairdressing or restaurants, will be only partly or only partially reflected in the price developments of the respective items. That's why we expect that there will be quite significant positive immediate second round effect of these indirect tax changes. These second round effects will last until the beginning of 2021, which is covering all the monetary policy horizon. In this table, you can see in detailed figures the individual tax changes concerning both administered prices and market prices, and you can also see the secondary effects that are primarily connected to the reclassification of certain items in terms of the VAT rate. Monetary policy does not react to primary effects of indirect tax changes, and it only reacts to their second round impacts. The macroeconomic conditions will lead to the fact that core inflation will only gradually decline from the current elevated levels, following the gradual fading away of domestic inflation pressures, which means especially the gradually decelerating nominal wage growth in business sector, and the decline in core inflation in 2020 will be curbed by those second round effects of the VAT change. That's why the more pronounced decline in core inflation can be visible only as from the start of 2021. Growth of food prices has been quite significant in recent quarters, let's say reflecting the fact that there are still some negative price effects of last year's very poor harvest related to dry and hot weather during last summer, which is having negative effect on prices, especially for certain agricultural items such as potatoes or tomatoes, etc. And we expect that during the rest of this year, food price inflation will remain elevated at the current levels, and this inflation will only temporarily decline, reflecting the agricultural produce price developments. The administered prices or regulated prices growth has been quite strong since the beginning of this year, and this strong growth will even somewhat accelerate towards the end of this year, following the fact that last year's fair discounts on public transportation for certain groups such as students and elderly people will fade away, which has been having curbing effect on regulated price growth since September last year until September this year. So this effect is fading away, and this is pushing regulated price growth somewhat upwards. And we can expect another increase in electricity for households during the rest of this year, which is also pushing the regulated price growth upwards. Following the expected gradual slowdown in electricity price growth and natural gas price growth as from the beginning of next year, we can expect deceleration of regulated price growth over the next couple of quarters as from beginning of this year. And this will lead to the fact that in 2021, regulated price growth will be roughly stable around 2%. Fuel prices will be basically slightly declining over the forecast horizon, following the previous decline of crude oil prices and the expected gradual appreciation of the koruna against the dollar. Here you can see the macroeconomic story or macroeconomic factors standing behind the picture of inflation I have just introduced to you. We are in the situation where overall inflation pressures are somewhat declining, but they are basically still quite significant. The decline of those overall inflation pressures in recent quarters, which will be propagated also in the quarters to come, is primarily attributable to the anti-inflationary effect of import prices. Import prices stopped growing a few months ago, and this is true for both energy component and the core component within the import price contribution. The domestic inflationary pressures strongly related to the situation in the labor market and in the domestic demand are still quite significant, but they have already started to gradually decline, and this decline will more or less continue on the whole forecast horizon. The lower chart is just showing the story from the domestic inflationary pressures point of view. We can expect that after some short-term temporary reacceleration of the domestic inflation pressures at the beginning of next year, which will be connected to the another increase of the minimum wage. The contribution of nominal wage growth in the business sector will continue to decline, which will be true for the rest of the forecast horizon. The labor efficiency growth has decelerated in recent quarters following the fact that Czech private companies, that the investment of Czech private companies has virtually stopped. But we can expect that some reacceleration of productivity gains or labor efficiency growth in the quarters and years to come, following the fact that investment activity will gradually recover. The positive contribution of the price of capital on the whole forecasting horizon is reflecting the fact that we predict quite solid, significant growth of domestic demand on the whole forecast horizon. The Czech economy has been showing quite strong resilience towards the economic deceleration in Western countries. So for the 2019, we expect that the GDP will grow by approximately 2.6%, but the deceleration of the growth, of GDP growth, is in the pipeline, and this deceleration will start already in the fourth quarter of this year, which is strongly related to the situation in the countries of our major trading partner. The growth will, from the annual perspective, decelerate in 2020 compared to this year, which will be, as I mentioned, driven especially by foreign demand developments. We can expect that after the foreign demand growth accelerates or recovers again, domestic economic growth will also accelerate to close to estimated potential output growth rate, which is 3% in 2021. The tightness of the Czech labor market has come to its peak in the recent quarters, but the tightness as such is still very, very significant. It prevents the unemployment rate from any further decline for the future, and the room for employment growth is also very limited and is given by a, let's say, relatively modest increase in labor force, which is related to the increases of participation rates of certain cohorts. Wage growth, which has been quite strong in business sector in recent quarters, will only gradually decelerate towards the estimated medium-term level, and this decline in wage growth will be curbed by another increase of the minimum wage as from the beginning of next year. Here you can see that the deceleration of GDP growth is really in the pipeline, and for the fourth quarter of this year, we expect GDP growth to decelerate to somewhat above just 2%. This year, we can identify a positive contribution of net exports to GDP growth, which is primarily linked with the subdued investment activity in Czech business sector. Next year, as the net export contribution will turn to negative territory, as the export performance will be negatively affected by the continued economic weakness in the countries of our major trading partners, and the positive contribution of net exports will, let's say, will be renewed again in 2021, which together with the expected renewal of investment activity growth in private sector will cause the GDP growth acceleration towards 3%, as I was already mentioning. As for the individual components of the demand, the forecast expects that the household consumption, which has been together with government consumption, very stable, very robust driver of the continued economic growth and continued domestic demand growth, will prevail for the rest of the forecast horizon. Disposable income of Czech households will be benefiting from the ongoing, albeit slowly decelerating, nominal wage growth in both business and public sector, and by other revenues of the household sector. Investment activity has been quite muted in recent quarters, which was primarily the effect of the investment developments in the private sector, whereas the public sector investment growth continued in relation to the EU funds drawdown. We expect that after the situation concerning the foreign demand prospect will kind of improve in recent quarters, investment activity of Czech enterprises will start growing again. And in the profile of both exports and imports, you can see the reaction to the temporary GDP growth deceleration in the euro area, and the subsequent recovery of both exports and domestic demand, especially the investment activity, will be driving the import activity growth towards more than 6%, and those figures, those paces will be very, very close to the export dynamics. As I was already mentioning, the employment growth has been decelerating, and it will almost stop in the coming couple of quarters with the contribution of hours worked per employee having more significant contribution to the overall figure compared to the employees' growth. And the currently still lowest rate of unemployment in our history and in the European context is preventing the ILO unemployment rate from further decline. That's why we expect flat unemployment rate on the whole forecast horizon. Here you can see that nominal wage growth in business sector is set to decline in the medium term. This decline will be at the very beginning of the forecast horizon kind of interrupted by another increase of the minimum wage. But this effect will gradually be more than offset by the declining tightness on the labor market, which will cause that in the environment of kind of decelerated overall GDP growth, the nominal wage growth will also decelerate towards 5%, which is the estimated equilibrium or medium-term level. We can expect that the quite pronounced and quite volatile nominal wage growth in public sector to continue in next couple of quarters, with some tendency to gradually decelerate also in the second half of the forecast horizon. The effort of Czech enterprises to protect their competitiveness and for profitability will let's say, lead to the slowing of nominal wage growth in business sector also, which I should have told you before when describing the nominal wage growth in business sector profile. The corona is expected to slightly appreciate over the forecast horizon, and consistent with the new quarterly macroeconomic forecast is a increase in domestic nominal interest rates in this quarter and the next, followed by their decline as from mid-2020. The starting condition of the nominal exchange rate forecast has been set at 25.7 korunas per euro. The subsequent slight appreciation is on the one hand side reflecting the domestic fundamentals, which is the continued real convergence process of the country and real equilibrium appreciation of the currency, together with some temporary further widened nominal interest rate differential of the koruna vis-à-vis the euro area. These domestic fundamentals will be to a certain extent compensated by the negative effects of subdued foreign economic and price growth, which is slowing down the tendency of nominal exchange rate to appreciate. That's why the appreciation is relatively mild, and koruna will not get below 25 korunas per euro until the end of 2021. Consistent with the forecast is a rise in domestic nominal interest rates in this quarter and the next, followed by their decline as from mid-2020. The rise in domestic nominal interest rates at the beginning of the forecast horizon is a reaction to a persistent domestic inflation pressures, which reflect the observed slowdown in labor efficiency growth, and these persistent domestic inflation pressures will be only gradually declining over the forecast horizon. To a lesser extent, the reaction of nominal interest rates, the increase of nominal interest rates in the beginning of forecast horizon is a reflection of the second round effect of those VAT changes I was describing at the beginning of my presentation. The expected subsequent decline in domestic interest rates as from mid-2020 is primarily a reflection of the very low, even negative foreign nominal interest rates, which are supported by the renewed QE program by the ECB. Now we can compare the new forecast with the previous one. The external side assumptions have been revised quite significantly to less pronounced economic growth and less pronounced foreign price growth, which is having anti-inflationary effect on the Czech developments. That's why we revised the GDP outlook somewhat downwards. On the other hand, the CPI inflation outlook has been revised somewhat to the upside, following the fact that we have identified a bit more inflationary domestic conditions in the initial state at the beginning of the forecast, which together with a weaker path of the nominal exchange rate, and together with the higher impacts of indirect exchanges is leading to this upward revision of the CPI for the next, let's say, 5-6 quarters. Nominal wage growth in business sector has been revised somewhat to the upside, following the fact that in this forecast we introduced the next or another increase in minimum wage, effective as from January 2020, despite the final decision by the government has not been taken yet, but we have done some assumptions regarding that. And the second factor explaining the upward revision of nominal wage growth in business sector is the identification of the fact that during this year, the basic pay component within the overall wage development has been more pronounced at the expenses of less pronounced contribution of bonuses. And this basic pay component is, according to our view, and will be more persistent than the bonus component, which is having an upward effect on the overall wage profile in the quarters to come. The nominal exchange rate path has been revised somewhat to the weak levels, which is the effect of the worsened foreign demand and price outlook. Here in these two graphs, you can compare the assumptions regarding primary and secondary effects of indirect exchanges in the new forecast with the previous assumptions. Basically, the primary effects are now expected to be a bit higher because the expected effect of the excise duties increases as from January next year will be somewhat higher than we anticipated in the previous forecast. Simultaneously, the launch of the third and fourth wave of the electronic sales registration has been shifted from January to May of 2020. That's why the effects related to this measure are also postponed in time. As for the second round effects, their magnitude has not changed much from the previous forecast, but their timing it has been also postponed or shifted more to the future, and currently the second round effects will be affecting the monetary policy inflation not only in 2020 but also at the beginning of 2021. Here we can see the decomposition of the interest rate forecast change, which is showing that in the upward revision, the overall upward revision of a nominal interest rate forecast has been given by a combination of factors. The initial state, more pro-inflationary initial state compared to the previous forecast, has been pushing to this direction. Within this more inflationary initial state, we understand under this effect we understand lower efficiency growth in the second and third quarter of this year, combined with the bigger role let's say basic pay of nominal wage growth in business sector played in our estimate in the second quarter of this year. The other contribution to the upside can be attributable to the exchange rate. The starting condition of the nominal exchange rate is on a weaker level compared to the previous forecast, which is having the effects on the nominal interest rates to the upside. The expert judgments we have introduced during preparation of this forecast have been related to the several factors, to the several phenomena. We introduced the postponement of the introduction of the electronic sales registration from January to May 2020. We also introduced the effect of another increase of minimum wage as from beginning of 2020. We also take into account the observed volatility of so-called package holidays prices in recent years, which might be somewhat reflected to the change of methodology from the Czech Statistical Office, and we prolong the expected effects of these developments to the forecast horizon. And that's and the wage rigidity has also been somewhat increased by an expert judgment following the experience or the observations from this year. The foreign environment has in total roughly neutral effect on the expected interest rate path. On the one hand, via lower foreign demand growth and lower foreign price growth, we will import less inflationary pressures, and domestic economy will generate somewhat lesser inflationary pressures compared to the previous forecast following the revision of foreign GDP and domestic GDP growth. On the other hand, the endogenous reaction of the exchange rate towards less favorable profile of net foreign assets and to the potential decrease in price competitiveness of Czech producers following the decline in foreign price growth. So these effects have led to the somewhat less pronounced appreciation of the currency in the new forecast, which is more or less compensating the anti-inflationary effects of a less optimistic foreign outlook. That's why the foreign environment as a whole has a quite neutral contribution in this graph. As you all know, we have been living in the environment of still unfinished negotiations regarding the Brexit. We prepared sensitivity scenario of a potential hard Brexit in the first inflation report of this year. And now we updated this scenario by using a more detailed model, which was used to simulate the effects of the potential hard Brexit on foreign economic developments. And we also updated the scenario by some other information available, as the process has not been finished yet. Despite the likelihood of this hard Brexit scenario has declined somewhat in the recent weeks following the situation in the UK. So in this graph you can see that the potential disorderly Brexit would have quite strong negative impact on the economic growth in the euro area, because the hard Brexit would quite significantly negatively affect the mutual trade between euro area and the UK. And simultaneously, using the more advanced version of the foreign economy model, we have also introduced some negative effects related to worsening sentiment and worsening productivity growth in the Western Europe. In this scenario, the anti-inflationary effect of declining GDP growth in the euro area is somewhat compensated or even outweighed by depreciation of the euro against the dollar, which is having a pro-inflationary effect. That's why the trajectory of foreign PPI growth was revised somewhat upwards compared to the baseline at the beginning of forecast horizon. But in the medium term, the anti-inflationary effect of lower growth will be prevailing. And the response of foreign monetary policy is towards more easing its stance by the combination of interest rate cuts and QE program, which is not, the combination of that is not discussed in this scenario in any way. But we would expect that in this scenario the ECB would lose its monetary policy stance further. The worsened economic outlook or economic growth in the euro area is having the same effect on the Czech economic growth. The Czech exports will be hit negatively by the fact that the UK leaves the European Union without the agreement, but the UK as such is relatively limited export market for the Czech enterprises, but the major effect is going through the collapsing export to the euro area, which is our major trading partner, and that's why GDP growth of Czech economy is significantly lower in this scenario compared to the baseline. Czech koruna is again behaving in an endogenous way to somewhat compensate for that. That's why the exchange rate path in this scenario is somewhat on a weaker side. But the domestic demand pressures will less pronounced domestic demand and domestic inflation pressures compensate this. That's why the CPI as such is virtually the same in this scenario as in the baseline, and the pressure on domestic nominal interest rates is somewhat to be somewhat below the baseline scenario, but very insignificantly. Having said that, I would like to thank you for your attention for now, ladies and gentlemen, and I'm passing the floor back to Markéta.
Thank you, Petr, for the presentation. Let's move to the Q&A session now. I would only like to ask you to introduce yourselves before taking a floor. Well, maybe you have the first question, please. I'm sure there is, okay. Jaromír Šindel.
Jaromír Šindel, Citibank. I would like to ask you about your fiscal policy assumptions, because you expect much better, let's say, fiscal surpluses compared to the Ministry of Finance own forecast, which is in average around 0.7% of GDP in next 2 years. So I would like to understand what is behind these assumptions, and whether the bank board perceive it as something like upside risk or downside risk to your forecast. And also, add to that, why do you assume EU funds investment activity or EU funds related investment activity to contribute 0 percentage points to the fiscal impulse in forthcoming years, given, let's say, some probability that still some investment activity is likely to happen financed by the EU funds in forthcoming years? That's all from my side. Thank you.
Okay, thank you for the question. Good morning from my side as well. I will say more broadly, and I suppose Peter will complete the answer because I do not know the details. Regarding the fiscal impulse, you have seen the presentation of the forecast. So what is generally our assumption is that the positive moments, positive aspects of expansion, some increase in expenditures in next year will be more or less compensated by some increases of the taxes. So therefore the result is zero plus minus. To the difference between our forecast and the last Ministry of Finance forecast, I will ask Peter if you like to comment, because this is the first question. Yeah.
The forecast, the fiscal forecast, is based on the assumption that the expected tax rates increases will successfully pass through the whole legislation process. That's why we introduced all the changes regarding indirect taxes. But the only measure which has been lately approved by the Parliament, which is the increase in parental benefit, has not been introduced to the forecast because of the unavailability of detailed description or classification and computations regarding this measure. It's true that for 2020 there are some further discretionary measures to have been approved by the Parliament, but their individual effects are close to zero, and if you round the figure to 1 decimal point, they are not. And furthermore, they are partly compensate each other on the revenue and on the expenditure side, and that's why the respective column is showing only 0.0 for all the components of the fiscal impulse. As for the contribution of the public sector investment growth, the current programming period has become to a stage where the annual growth rate of public investment activity co-financed from the EU funds has got to a stable growth or stable slight growth, which is not delivering major contribution to the overall fiscal impulse. And we can expect that sharp acceleration of investment activity growth can be in public sector can be expected only as from beginning of 2021, as we will be approaching the end of N+3 rule, which is applying to the current programming period. That's why there are also. That's why there is zero contribution of this item. As for the comparison with the Minister of Finance forecast, they released their forecast just yesterday, so I didn't have much time to look at their forecast. But basically, as for the fiscal side assumptions, we tend to be very close to them. And as I was mentioning at the beginning of my contribution in this debate, the parental benefit might be one particular difference between our and their forecast.
Thank you. Jakub Seidler.
Jakub Seidler, ING Bank. Good day. I just wanted to ask, the exchange rate was significantly changed in this forecast for next year, I think it's weaker by 2%, in 2001 by 3%, which basically means that the monetary tightening assumed in the previous forecast is not delivered by FX right now. And given the rule of thumb, which was used by the Czech Central Bank previously, that 1% change in the exchange rate is equal to one hike, I would be expecting even much stronger increase in interest rate, especially given the fact that 2021 was not revised significantly downwards, and this is the monetary policy horizon. So what is this inconsistency, or whether the Czech Central Bank changed the rule of thumb and it's not using it anymore? Thank you very much.
When comparing the exchange rate path and its contribution to CPI and interest rate outlook, in this particular case, one cannot use the UIP shock impulse response kind of figures, because this the effects which have been implemented into this forecast are not cannot be described as UIP shock. This is a fundamental endogenous reaction of the exchange rate to less optimistic foreign demand developments, including outlook, and very subdued foreign price growth, which is by definition somewhat decreasing price competitiveness of Czech exporters. And that's why the reaction of the exchange rate is the exchange rate reacts as a kind of built-in stabilizer or adjustment mechanism, kind of partly offsetting the anti-inflationary effects of the worsened foreign outlook. So this is my first remark, and my second remark is that until now we have had tendency to explain almost fully the observed stagnation of the exchange rate as from beginning of 2018 as a reflection of the worsened global sentiment, because we didn't see much effects of foreign economic deterioration in domestic variables. That's why we, in the previous forecast, introduced so-called longer-term or persistent part of the country's premium to be able to explain the observed exchange rate stability. Now we still have this factor in the exchange rate forecast, but we could somewhat diminish its effect because of the fact that the model mechanism now sees that there are fundamental sources or fundamental reasons for koruna to appreciate less aggressively compared to the previous forecasts following the worsened foreign growth of GDP and of prices. That's why the exchange rate revision to weaker levels doesn't have as pro-inflationary effects as one might think if looking at just at the forecast, at the path as such. But the story behind this is much more complicated, and one cannot simply use the standard exchange rate sensitivity scenario.
Thank you. Who's next? Yes, please.
Martin Poe, General Investments. I would start with a follow-up question to the previous one. It's really hard to understand, the explanation behind the exchange rate revision, at least for me, because you point to the weaker outlook of foreign demand. The revision is quite substantial, 2%. On the other hand, if we look at the interest rate forecast, we see that also the interest rate forecast has been revised up quite substantially. So I feel a bit sort of contradiction. Are there really no other factors that have somehow contributed to the substantial revision to the exchange rate forecast. I would have one more question, and it's more to Mr. Governor. The board decided not to follow, let's say, the advice of the forecast and not to increase interest rates, pointing to downside risk. When do you think it will be possible to say whether these downside risks materialized or not, and which of these downside risks do you consider to be most relevant?
Okay, so Peter, you will start.
I will start by the explanation of the change in the forecast. The foreign outlook has been revised significantly downwards, except one important variable, which is foreign interest rate. And this is creating kind of mutual inconsistency in the foreign outlook, especially if we use it when explaining the change of the forecast for several endogenous domestic variables. Basically, one would expect that if there is such a dramatic change in the foreign prospect, the ECB would be expected to increase, to relax its monetary policy more dramatically, which is not the case. The market expects that the ECB rates will stay roughly flat, or there might be one marginal rate cut, and that the program, or the QE program, will not increase in terms of volumes. And this is ceteris paribus pushing the domestic interest rates upwards, because if there is proportionate decline in foreign interest rates to the decline in foreign GDP and price outlook, this would automatically kind of open again the interest rate differential vis-à-vis the Czech koruna. And if this is not the case, because of the flat market outlook of the ECB's policy, this might be kind of replaced by the domestic interest rate path to prevent the koruna from depreciate too much to endanger the fulfillment of the inflation target on the monetary policy horizon. So the koruna lies on a weaker side compared to the previous forecast, which is the reaction of the endogenous reaction to less inflationary effects from abroad. But simultaneously, if there is decline in the foreign interest rates, the domestic interest rate could have gone downwards as well. But this is not the case in the baseline scenario, and that's why the overall effect of foreign outlook on domestic interest rates is close to zero. The CPI forecast has been revised upwards following three other things. The first is the more inflationary initial condition in the economy. If we look at the figures on the labor market, in the GDP breakdown, etc., we saw that the initial condition is much more pro-inflationary compared to the previous forecast. Second, we introduced the higher effects of indirect tax changes. And thirdly, the exchange rate starting condition is somewhat weaker, even weaker than would be consistent with the worsened foreign outlook. So if those three things add up, they will create the upward revision of the CPI,
which is then reflected in the nominal interest rate outlook revision also.
Okay, so I will try to comment your second question. First of all, I would like to stress that we are always taking our decisions in environment of uncertainty. It's always about the future. It's always about probability. If the assumptions of the forecast and some other assumptions of other guess we include in our decision making is somehow unsecure, of course. So and this will not change in the next round. So it will be always the same. So it's very difficult to say what does it mean that some of the uncertainties or risk we mention in our risk statement will materialize or not, of course, and where is the measure, the hurdle for that to state that these has materialized or not fully or partially or something like that. I would say that there was not a big gap between what the monetary department has stated about the condition of the economy and what the board has said about that. Of course, in average, in some specific cases, there could be wider gap, in some not. But what is the true is that, in fact, the board, in average, has pointed out a bit more some of this risk which are mentioned and which we have, let's say, assessed as relatively high regarding mainly the growth prospect in EU and in relevant Eurozone from our perspective in the next quarter. So it's more about some kind of let's say small fine differences between our perception in this assessment and what department was saying in their description of the situation. So we will see, next time what will be the new assessment of the meantime development before last session and the next one in December, and difficult to say at the moment that or specify at this moment is very difficult to specify the very concrete kind of hurdles that which we could approve our next decision. So I will stay on this very, very broad and general statement.
Thank you. Maidan.
Thank you. Mai from Bank of America. Just a follow-up question. Thank you, Mr. Governor. In the previous decision, you commented that you basically guided the market that the next debate will be still a hike or hold. What do you think is the situation now? You probably were not that clear in the press conference yesterday. And another question is, in the statement of the bank board, the reason to hike rates include the fact that there's a concern about inflation expectation being anchored at a high level. If you could elaborate a bit on what are the evidence that support this or not supporting this, so that we can watch from the market. Thank you.
Yes, I will start with the second one. What I have commented on the press conference was the more or less. I try to summarize the arguments of both groups. So definitely the dissenter groups, they argued, well, amongst many other things, that there is a question of the encourage of or how the inflation expectation could be encouraged for the future if we do not follow, let's say, repeatedly the recommendation to increase the rates. But I have to say that the group who advocate the stability of the base of the rates, of course, argue that there is no evidence yet, at least, that the inflation expectations would be not encouraged on the, let's say, standard level, which was the case so far. So there is no evidence yet about this. It was more about the potentially worse developed in this respect. So that's first. The second one, we will see, of course, what will be next monetary session. The main issue, the development is quite dynamic, not only here but also outside mainly. So we will see. I can imagine both that more or less will be the same as last two sessions. So, or to stay or to increase slightly. I can imagine as well that will be more or less clear that we will stay in a certain current on the current level. So difficult to let's say at the moment very strongly something about it. But I do not suppose. Okay, I will stay here.
Okay, who's next? Pavel Sobíšek.
Pardon. Pavel Sobíšek, Unicredit Bank. Let me turn your attention to GDP Outlook. The central bank has been more optimistic than the consensus for quite a while, and despite the gap probably going slightly lower now, the gap remains. And if I read correctly from your presentation, it's because of more optimism from your side about household consumption. It is definitely not because of a higher expectation about income of households. So the reason must be in the expectation of lower savings ratio. And my question is, why? What's behind that? Thank you.
Our forecast of household consumption is consistent with roughly stable savings rate of household sector in the forecast horizon. So from this source, there is no further acceleration of the expected consumption growth. We just have got together all sources of disposable income as traditionally defined, standardly defined by national accounts. So not only the wages and salaries, but also entrepreneurs' income, social benefits, other income, etc. And this is in the end of the day resulted in quite pronounced disposable income growth in the years to come. There will be some negative effect on private consumption stemming from the reacceleration or from the effect of increased inflation for a longer period of time compared to what we anticipated before, which is related to the indirect exchanges, which are now more pronounced compared to the previous forecast. But this will not dramatically erode the purchasing power of domestic households. That's why the household consumption is expected to grow around 3%, and the revision compared to the previous forecast was only marginally downward. So there is no big change of the picture here. And if I'm not mistaken, yesterday there were retail sales data published by the Czech Statistical Office for September and for the third quarter as a whole, which I would say pretty much confirm the story of continued robust household consumption growth in the current juncture.
Thank you. Another question, please. Yes, please go ahead.
Luboš Ružička, Raiffeisen Bank. In your current forecast, you significantly revised assumptions about foreign development, especially in the case of prices. There is a significant drop in production prices abroad. There is also assumption about decrease in agriculture prices, oil prices are lower, and you expect import prices to decrease in the forecast. But despite this significant revision of these factors which influence the CPI inflation, the inflation in 2020 is higher compared to the previous forecast. As I understand correctly, it's mostly due to administrative factors, especially administrative prices and change in taxes. So could you elaborate more about, in more details, describe what is behind the shift in inflation forecast? Thank you.
I'll start with the administrative side. The estimated effects of the excise duties increases regarding cigarettes have been revised upwards by 0.24, by quarter of a percentage point compared to the previous forecast, because we recalculated the effects of these excise duties increases, having in mind the precise structure of consumer basket, and it resulted in the fact that the total price increase following this excise duties change will be somewhat higher compared to what we anticipated before. The second part of administered effect is the upward revision of regulate price growth following the effect of more marked more marked increase in in price of electricity at the end of this year and the beginning of next year. And beyond those administered factors, there are more fundamental contributions to the upward revision of the inflation outlook, which is related to a bit more pro-inflationary domestic inflation pressures at the beginning of the forecast, which was, as I mentioned during my presentation, related to the less intensive labor efficiency growth we can identify now during 2019, together with more potentially more persistent or expectedly more persistent nominal wage growth in business sector in this year and in the years to come, reflecting the fact that the second quarter outcome for an average nominal wage growth in the business sector was more was driven by was driven more significantly by the basic pay component within the wage developments at the expense of the bonus component. And the basic pay component of nominal wage growth is assumed to have bigger persistence compared to the bonus component, and this is having the upward effect on nominal wage growth on the whole forecast horizon. So those changes of in interpretation of the fundamentals, together with somewhat a weaker exchange rate and together with the administrative factors, have in total contributed to that revision of the CPI outlook.
Thank you. As we are running out of time, I'm afraid there is room for one more question only. So, Jan Vejmělek, please.
Thank you. Good afternoon, ladies and gentlemen. I'm sorry, but I will return back to FX. I would like to see, let's say, more details regarding structural composition of changes in your forecast, current one compared to the previous one. Is the current FX outlook only a, let's say, model-based one, or there is also a significant portion of expert judgment in the FX forecast? And my second question is on the alternative scenario, hard Brexit. I assume that this alternative scenario was ordered by the board. Why this scenario? Do you think this is the key risk for our economy, or there are other risks discussed on the board? Thank you.
I'll maybe start. Yes, of course, it was ordered already a bit earlier. It was not just before this last report, because we have dealt with this issue, of course, already for a while. Yeah, definitely, Brexit is one of the very specific risk which we are considering amongst those uncertainties and risks. And Brexit is something which is, I would say, much more tangible than many others, very general issues which are mentioned repeatedly. So we ask the staff to prepare these sensitivity scenario for that. But it doesn't mean that the Brexit is only one and only significant which is on the horizon of our thinking and decision making. Of course, there are also some others, much more even, I would say, maybe a bit longer horizon perspective, but definitely other things which are taking in our consideration. I mean, generally the slowdown in the Eurozone, some structural changes in automotive, energy sector changes, structural changes in energy sectors, mainly Germany and other. So it's of course not only Brexit.
As for the exchange rate forecast, I don't want to repeat the story I was delivering during the presentation and during the previous response to a question. So I will start from the other side. When we were deriving the forecast, we were asking ourselves whether the combination of the until now used arguments of increased, of worsened negative sentiment, having a negative bearing effect on the exchange rate, in combination with fundamental factors such as worsened foreign economic and price outlook would be or would not be too much for the exchange rate to derive a reliable path. That's why we were reconsidering the effects of the previously increased country risk premium, which until now has helped us to explain the stability of the exchange rate after spring 2018, and we somewhat expertly decreased the effect of this higher country risk premium in the model, because now the model has enough kind of information to explain the weakness of the currency by fundamentals from abroad. So this was the kind of small expert adjustment on or change compared to the previous forecast we introduced now to kind of address the newly available information, especially the outlook.
Okay, thank you. With the last question answered, allow me to close this meeting by expressing thanks to both our speakers and add our thanks also to you for coming and participating in this discussion. And since it's the last meeting of the year, we would like to invite you to a traditional lunch and a chat at the Banks Club on the ground floor. Thanks again, and for now, goodbye.